a lot of smart people still think that the US dollar is backed by gold. It is not backed by gold. Like, everybody just listen. It's not backed by gold. It's backed by nothing but trust, period. So no, there's no gold. We stopped, auditing Fort Knox a long time ago. There's no gold protecting the US dollar. That's number one, right? So people are starting to understand that, and which is really important. And then going back to your other point, which is people are starting to understand that, and this is really important this last week, that, oh, damn, if there's a run on the bank, they may not have my money because of what you just said, fractional reserve. And I think, sometimes we think that we're just in our echo chamber here, but enough people filter in to see what's going on, and they read your podcast, they read the title or the show notes, and they realize, hey, maybe I ought to listen to this. Maybe these Bitcoiners aren't so crazy after all, because we've been talking about this bank situation, the debt situation, the leverage situation, the interest rate situation, the Fed, central banks. We've been talking about this for years now, and unfortunately, a lot of it's coming to fruition.
Yeah, if you hang out in libertarian, gold bug, Bitcoiner circles, we've been talking about this literally for decades, right?
Yeah.
Ron Paul talking about end the Fed, audit the Fed. There have been people looking at US debt clock. That's now just, as we were talking about, like this massive level of debt. And that is not even counting what's called the fiscal gap. That's not even counting other things that are still yet to be paid out in terms of pensions and things like that. And those liabilities, when you add them all up, and you look at that debt clock, it's $200 trillion, right? So, it's really hard for people to conceptualize. What does that mean? How does that even relate to me? And these are what you're talking about, is the unfunded liabilities. Like, how does that even relate to me? Well, maybe my kids will pay it off. We'll fix it. We've balanced the budget before, right? But you've got three choices. You've got three choices in a situation like this. You can either cut spending, austerity, right? But that's political suicide. Who's going to cut spending? Who's going to cut spending on what program? You're going to lose voters no matter what. And we know that policy is shaped by voters, and voters are, but policy is also shaped by special interests. So what program are you going to cut to hurt a special interest group that's going to then not fund your next campaign? That's really what it comes down to. It's all bullshit, right? So that's number one. There's no austerity that's coming. So I get comments like that all the time. Well, we just need to, we need to spend less. Good luck. Okay. So that's number one. Number two is you could raise taxes. You could raise taxes on the wealthy, on the, on the people who, that should be paying more, or on companies. You could raise a corporate income tax. You could tax unrealized gains. What a mess that would be. That would only serve to what? It would reduce productivity. It just has the same effect in the long term. That won't work. And then, your third choice is to issue more bonds. That's it. Issue more debt. And that's the easiest one. And so they keep doing that, keep raising the debt ceiling. And we can talk about that if you want, but and then finally, if they keep doing that, what's their next move? Well, their next move is to let inflation run a little bit hotter than everybody realizes. Why? Because if you let inflation run hot, then you get GDP up in nominal terms, right? Because the dollars, there's more dollars, the GDP goes higher because there's more dollars. Inflating away the real terms of the debt. So you're basically making it easier for you to repay the debt by printing it.
Correct. You're taxing dollars that are cheaper, and then you're paying off old debt. So how would you like to have a debt for a bond that you own for 30 years, right? You buy a bond today for 30 years and it's going to yield you, 4 or 5%. Okay. Well, for 30 years, we all know that real inflation, true inflation is much higher than that. So what's the dollar going to be worth? If you put $1,000 down today and you get $1,000 back in 30 years, what do you think that's really worth? Is it worth the interest that you got along the way? A whole lot less, right? So, you know, that's the problem. And so as people are beginning to realize this, they're realizing that we're just inflating away that old debt. And that's where the confidence begins to wane. And that's why when you get, you know, massive countries like Russia sell all their treasuries and say, I don't trust that the inflation numbers are right and that this is a good use of my own assets, the oil reserves in my ground. I'm not going to, you know, monetize those with U.S. treasuries and get paid dollars that are pretty much worthless in 10, 20, 30 years. So they completely sold their U.S. treasuries, you know, and our largest buyers are starting to get skittish about that. That's a problem. You know, that's a major problem.